A major geopolitical crisis is rocking the global markets right now. And smack in the middle of all of it, Bitcoin is facing what might be its biggest test yet. But this isn't just about the price swinging up and down. This is actually revealing some powerful new forces that are fundamentally changing how Bitcoin even works.
Okay, so let's dive right in. It all kicks off right here, in March of 2026. A crisis just blows up in the Strait of Hormuz, which is basically a critical energy artery for the entire world, and you can see the reaction right here. It was immediate and it was dramatic. Oil prices just exploded, and right away, everyone started fearing a brand new inflation crisis.
Now, the shockwaves from that event, they didn't just stay on the energy markets. No, they traveled far and wide, and they slammed directly into the world of crypto. So the big question is, why? Why on earth did an oil shock send such massive waves through Bitcoin? Well, in this explainer, we're going to connect those dots and really dig into the surprising, complex, and honestly, the pivotal reaction that we saw.
First things first, we really need to understand the sheer scale of this disruption. This was not some minor hiccup.
We're talking about a choke point that literally controls about a fifth of the world's daily energy supply. A fifth. So this crisis physically threatened the flow of the oil and gas that powers the entire global economy. It got so bad that countries like Qatar, Iraq, and Kuwait, they were actually forced to halt production. That's a huge deal.
So let's see how this starts to build. Because, well, an energy crisis of this size, it very quickly becomes everybody's problem.
And this wasn't just a little price bump we're talking about. A surge of over 60%? That's a massive inflationary shock, and it instantly threw a giant wrench into the plans of central banks all over the world, forcing them to deal with a whole new and very scary reality.
And here's the crucial part. That nice, stable economic environment everyone was kind of hoping for, yeah, it pretty much vanished overnight. All of a sudden, those inflation targets looked totally impossible. Any hopes for interest rate cuts? Gone. And rising bond yields started signaling some serious anxiety about the future. For every investment out there, including crypto, the whole landscape turned hostile, just like that.
And that brings us to Bitcoin. Because in the face of all this chaos, its reaction was violent, it was complicated, and frankly, it was absolutely fascinating to watch.
So Bitcoin's price didn't just kind of drift up, it shot up, liquidating over $186 million in short positions. But here's the thing, this initial pump wasn't just a wave of excited new buyers. No, it was something way more technical. It was a painful short squeeze, a mechanical move that can actually tell us a whole lot about the market's inner plumbing.
So what in the world is a short squeeze? Well, you can think of it like a mechanical chain reaction. You have all these traders betting the price is going to go down, right? When the price shoots up instead, they're forced to buy back in just to cover their losses. And that buying action pushes the price up even more, which then forces even more short sellers to cover. It's this wild feedback loop that doesn't necessarily mean new, real buyers are flooding the market.
And that mechanical action, it actually shows us the market's internal structure. You see, analysts saw a clear path of least resistance, a big push toward that $72,000 mark, which is where a lot of those short positions were clustered. But after that, the data was suggesting a potential pullback to a much larger zone of orders sitting between $64,000 and $68,000.
Now this is where it gets really interesting, because what was happening just beneath the surface price was incredible. A powerful, kind of invisible battle was playing out between these huge opposing forces, a battle that was going to determine Bitcoin's next big move.
Just think of it like a giant tug of war. On one side of the rope, you've got all these negative global economic forces, the oil shock, inflation, fears about interest rates, all trying to pull the price down. But on the other side, you've got these incredibly strong crypto-native positive forces, like record demand for the ETFs and a shrinking supply, pulling that price right back up. So on one side of that tug of war, we see something pretty remarkable happening with the traditional safe haven asset, gold. Capital has been just pouring out of gold ETFs. We're talking record outflows over the last month.
And this is just a brilliant illustration of where a lot of that money might be going. During that exact same period, a staggering $934 million flowed into the new spot Bitcoin ETFs. This hints at a massive structural shift, with big institutional capital maybe rotating out of gold and directly into Bitcoin. And at the exact same time, the supply side of the equation is getting tighter and tighter. I mean, the amount of Bitcoin actually available to buy on exchanges has dropped to levels we have not seen since 2019. This is a classic sign of conviction. Long-term investors are moving their coins into cold storage. They are not getting ready to sell.
And get this,
Even with a unique seller out there, like the entire nation of Bhutan, liquidating its government holdings, the market is just absorbing it with ease. I mean, they've sold off over half their stack, but they're doing it in such a structured way that it's not crashing the price. This is a clear sign of a maturing market, one that can handle really large sales without totally freaking out.
Okay, so you've got these incredibly powerful forces just pulling in opposite directions. The big question, the one everyone wants to know, is where does the price go from here?
Well, there's one really popular valuation model, the stock-to-flow model. It basically measures an asset's scarcity, and it's pointing to some truly astronomical numbers. We're talking an average price of $500,000 for this cycle.
But, and this is a big but, it is so crucial to be realistic here. Let's pump the brakes a little. Critics will rightly point out the model has been wrong before, and for Bitcoin to hit those kinds of prices, its market cap would need to swell to around $10 trillion. Now, that's not impossible, but it would require a level of global adoption that we just haven't seen yet. It's much better to think of this as a way to understand scarcity, not as a crystal ball for prices.
So when we actually ground ourselves in the current data, two probable paths really start to emerge. The bull case sees Bitcoin punch right through that $72,000 level and start climbing towards the $85,000 to $90,000 range. Now the bear case sees it briefly push past 72,000, to force all those short sellers out, and then pull back to a stronger support zone, somewhere between 64 and 68,000 for a healthy correction before the next big move up.
And all of this leaves us with one final, pretty provocative question. As all this Wall Street money floods in and the available supply of Bitcoin keeps shrinking, are we witnessing a fundamental change in what Bitcoin is? Is it losing its rebellious cypherpunk spirit and just becoming another tool for the financial elite? Or is this the moment it finally forges its own independent path, completely reshaping the future of finance as we know it? That right there is the multi-trillion-dollar question.